Hello guys, welcome to the Forxeduline YouTube channel. First, let me point out that this video is for education only. It is not investment advice. All trades are your own responsibility. Always check your plan and manage your risk before you enter any trade. Today we are going to dive into one of the most popular reversal patterns used in technical analysis, the head and shoulders pattern. The head and shoulders pattern is actually a super powerful formation, especially because it can signal that a bullish trend is coming to an end. Let's start this step by step. These are the topics to be covered in the video. 1. What is the head and shoulders pattern? 2. Structure of the head and shoulders pattern. Left shoulder, head peak, right shoulder, neckline pattern, height or formation height. 3. Entry point 4, stop loss level 5, target point, take profit. 6. Examples on real charts. 7. Most common mistakes. The head and shoulders is a pattern you usually spot late in an uptrend, signaling a high probability that the price is about to reverse and head lower. Its structure is made up of 3 main parts: the left shoulder, the head, and the right shoulder. When we see this 3-part structure form, it tells us that the buyers are getting exhausted and the sellers are finally starting to take control. Now let's take a look at how the head and shoulders structure actually forms, step by step. In this section, we will explain in detail how the left shoulder, the head, and the right shoulder take shape, and how the neckline is determined. Let's start with the left shoulder. While the price is moving inside an uptrend, it makes a peak. This peak is considered the left shoulder. Then, as buyers lose strength, the price pulls back. This pullback usually goes down to a certain support area, close to the neckline. During the formation of the left shoulder, volume often increases at the beginning of the move, decreases as the price reaches the peak, and may rise again as the price drops. In short, the price moves up and creates a top. That top is the left shoulder in the structure of the head and shoulders pattern. Now let's move on to the most important part of the pattern, the head. After the left shoulder, the price moves upward again, and this time creates a higher peak. This peak is the head of the pattern. The fact that the head is higher than the left shoulder is the clearest sign that the structure is forming correctly. During this rise, volume may sometimes remain weak, which can show that buyers are not as strong as before. Selling pressure in the head area is usually stronger, and the price starts moving downward again. Then the price recovers again and makes another move upward. But this time, the peak cannot reach the level of the head. This structure is the right shoulder. The right shoulder is identified by creating a lower high compared to the head. It is usually close to the height of the left shoulder. During the formation of the right shoulder, volume is often lower, which shows that buyers are getting weaker. Once the right shoulder is completed, the price moves downward again and heads toward the neckline that I will explain next. Now let's explain the neckline of the pattern. The neckline is the line that connects the low point of the left shoulder with the low point formed after the head. This line is one of the most important parts of the pattern because the breakout happens exactly here. The neckline can be flat, and it can also be angled up or down. If both low points lie on the same level, we call it a flat neckline. This version is very clean to read because the support area is almost a straight horizontal line. Many traders find it easier to spot since the lows match each other clearly. When the price comes back to this line, it becomes a very distinct decision area. If the second low is higher than the first one, the line slopes upward, and this is an upward sloping neckline. This shows that buyers were still able to push the price to a slightly higher low. Even though the pattern is forming, the market still has some upward momentum. Because of this structure, the neckline points a bit higher as time goes on. If the opposite is true, and the second low is lower than the first one, Then we have a downward sloping neckline. In this case, the support area is weakening. Each time the price returns to this line, it settles at a slightly lower point. The line moves down as the pattern develops, and this makes the structure easier to recognize on the chart. When this line is broken, the pattern is considered complete and confirmed. The left shoulder is where buyers first start to struggle. In the head section, price makes one last push upward, but loses strength. In the right shoulder, this strength weakens even more. The neckline shows the level where the entire structure breaks. When these four elements come together, the head and shoulders pattern is fully formed. Now let's explain one of the key measurements of the head and shoulders pattern, the height, also known as the H value. The height of the pattern is the vertical distance between the highest point of the head and the neckline. This distance is used directly when we calculate the target. Here is how we measure it. First, we identify the highest point of the head on the chart. Next, we determine the level that passes directly below the neckline. The vertical distance, or difference between these 2 points, meaning the distance from the head down to the neckline, is considered the pattern height, or the H value. After finding this height, we apply this same distance downward once the price breaks the neckline. In other words, starting from the breakout point, we measure one full H down. This gives us the average target the price may reach. This method is widely used in classic chart analysis and has worked in many real examples. Measuring the height correctly helps us find the target more accurately. To sum up, the vertical distance between the head and the neckline is the H value, and this distance is used directly to calculate the target after the breakout. The most common way to enter a trade in the head and shoulders pattern is when the price breaks below the neckline, which shows the pattern is now active. If you prefer a safer entry, you can wait for the price to come back and touch the neckline after the break. This is called a retest, and many traders use it to avoid false breakouts. During the break, an increase in volume helps confirm the move and shows that sellers are stepping in with more strength. Some traders enter right at the break, while others wait for the retest. Both methods are used, and the choice depends on your own trading style. The stop-loss level is very important in the head and shoulders pattern. The most classical stop placement is slightly above the breakout area. This gives the trade some space in case the price makes a small pullback. Some traders prefer an even safer approach and place the stop above the top of the right shoulder. This keeps the trade protected from quick spikes that may happen before the move continues. Both methods are used often, and the choice depends on how much room you want to give your trade. Calculating the target in the head and shoulders pattern is quite simple. First, measure the distance between the highest point of the head and the neckline. Then, apply this same distance downward from the breakout point. This gives you the projected price target. This method is widely used in technical analysis and has been confirmed in many real examples. By measuring the height carefully, traders can set realistic targets and manage their trades more confidently. Let's now examine these concepts using a real chart example. The chart you see here shows a head and shoulders pattern with an upsloping neckline. This means the neckline is tilted upward rather than flat. The low point between the left shoulder and the head sits lower than the low point between the head and the right shoulder, so the second low is higher than the first. An upward sloping neckline indicates that buyers, bulls, were able to keep the price slightly higher even before the pattern was fully completed. This shows that there was still some strength in the market pushing prices upward. Once the pattern is complete and the price moves below the upsloping neckline, it serves as a very strong confirmation that sellers, bears, have taken control. This shift often leads to a faster and more aggressive decline compared to patterns with flat or downward sloping necklines. Overall, observing the slope of the neckline can give us an early indication of the anticipated speed and strength of the upcoming move. The chart you are currently looking at shows an example of a head and shoulders pattern forming at the end of a bullish trend. This time, however, the most critical support line of the pattern, the neckline, has a down-sloping structure. The neckline connects the two pullback points of the pattern, the low between the left shoulder and the head, and the low between the head and the right shoulder. In a down-sloping neckline, the low point between the head and the right shoulder is lower than the low point between the left shoulder and the head. If you extend the line, you can clearly see that it slopes downward. As the price forms the head and then pulls back, the next low that appears before the right shoulder forms remains below the previous low. This situation gives an early signal that buyers, bulls, are losing strength, and sellers, bears, are gaining control at progressively lower prices with each pullback. A head and shoulders pattern with a downsloping neckline confirms that the pattern is forming in a weak market. A break below this neckline sends a strong bearish signal as the price loses both the pattern support and the overall trend support. Traders often expect such a breakout to lead to a fast and sharp decline. This real chart example demonstrates how the head and shoulders pattern can be applied in actual trading. It clearly shows where a trader could enter the trade, how to properly place a stop loss, and how to determine a target using the height of the pattern. By observing the formation on the chart, you can see how the price moves through the left shoulder, head, and right shoulder, and how these points guide key trading decisions. Using the height of the pattern allows traders to set a realistic target, while the stop loss placement helps manage risk effectively. This example highlights how the head and shoulders structure provides a practical framework for planning a trade, showing not just the pattern itself, but also the step-by-step process of applying it in real market conditions. The real chart you are looking at right now, you can see definitive proof of why the head and shoulders formation is considered a powerful trend reversal pattern. The formation and the events that follow tell a story of how the strength in the market gradually shifted from buyers to sellers. As shown, the pattern emerged at the end of a long-lasting bullish trend. Each stage of the formation demonstrates how buying pressure within that trend gradually diminished. The critical confirmation of the pattern occurred when the neckline was broken. After the pattern was completed and the neckline was breached, the price began to drop rapidly, marking the beginning of a new bearish trend. This swift decline serves as evidence that the trend has fully reversed and that sellers have taken control of the market. In summary, the head and shoulders pattern not only signals a trend change, but also illustrates the psychological shift among market participants and the exhaustion of the previous trend. For this reason, it is regarded as one of the most reliable reversal signals in technical analysis. Opening a trade immediately upon spotting a head and shoulders pattern is not always the right approach. There are several pitfalls traders should be aware of. 1. Entering the trade too early. 2. One shoulder is much higher than the other three. Lack of a preceding trend. 4. Breakouts with low volume. 5. Incorrectly drawing the neckline. In this chart, the left shoulder almost reaches the level of the head. This reduces the symmetry of the formation and makes it less reliable. Trading based on this setup can result in false signals because a properly balanced head and shoulders pattern requires the shoulders to be noticeably lower than the head. In this chart, the right shoulder is nearly at the same level as the head. Even though the left shoulder is positioned normally, the height of the right shoulder disrupts the pattern's balance. This makes it difficult to confirm a valid reversal, and entering a trade here could lead to unexpected outcomes. For the head and shoulders pattern to function properly, it must appear after a clear upward trend. If there is no strong prior trend, the pattern might just be a normal price fluctuation rather than a true reversal signal. In other words, if the price is not moving within a distinct trend, the reliability of the pattern decreases significantly. On the chart you are viewing, the preceding trend is evident, which makes the formation valid. Additionally, traders often make mistakes such as relying on breakouts with low volume, which can act as traps. Incorrectly drawing the neckline can also result in miscalculating the target. Being aware of these common errors is essential for applying the head and shoulders pattern effectively and avoiding unnecessary risks. Dear viewers, I would greatly appreciate your support. If you like this video and subscribe to my channel, it really helps me continue creating more content. Thank you so much for your support, and I look forward to seeing you in the next videos.